Financial products are not always easy to understand. And generally speaking, something that's more difficult to understand is probably not the best product. If you're not able to explain to your um, neighbor in about 5 to 10 minutes what you purchased, then it's probably not the best product. But what I'm going to be doing is going over that, and I'm going to speak real slow so it can be translated on YouTube into Portuguese. Because the client that reached out to me is from Brazil. Now, there's a company out there. They're going to remain nameless. I'm not going to, call them out. Um, but there's a company out there that is making incredible inroads into the Brazilian community, and they're selling them a product that is hurting that community. They're lying to them. They're not being truthful about what their product actually does. They're selling it as an investment when it's really not a good investment product at all. And we're going to discuss that, and we're going to let you, we're going to present my case before you and let you make the decision. Okay. So that's the ultimate goal of this presentation, is to walk through it. Now, the reason why it's titled Enough is Enough, because I'm done with this company and what they're doing to people. They're going to hurt people in the next 5, 10, 15, 20 years of people investing in this product and putting their money into that product. They're going to lose so much money. They're going to be hurt financially. So that's why it's very important that I go over and discuss this product. And the reason why we do what we do is we're here to help families. We're not here to hurt families. We're here to sit down, educate, work with families so they can win. I'm going to turn my camera off right now so we can focus on just the presentation for the rest of this time together. So enough is enough. All right. There's going to be 3 things we're going to talk about. Actually, 6 things. We're going to first talk about how money works. Second thing we're going to do is talk about professional licenses. Third, and why we're here today. The fourth, we're going to talk about insurance. The fifth, we're going to talk about investment. And then sixth, the reason why we're here is to continue to tear apart the whole concept of what was in that video. How money works. Common sense guide to financial success. So we want to teach you how to pay yourself first. That is such a primary item when it comes to how to win the money game. You pay yourself first. Now, one of the great ways to look at this, it's not what you keep, it's what you earn. So this is a great way to, and this blows people away every time we talk about it. You calculate how much you've earned and how much you've saved. So average annual income, we're going to have, let's say that is $50,000. Okay, so you make 50 grand a year. Number of years you've worked, let's say you've worked 10 years. So you've made over $500,000 in that time period. Okay. Now you have to ask yourself, how much money do you actually have sitting in your bank? And normally it's not going to be a lot of money. People basically, they live paycheck to paycheck. They spend everything that they earn. Now, this percentage gives you an idea of you got to figure out what your percentage is. Figure out what you're making a year, multiply by how many years you've been making that. That'll give you the amount. That'll give you an idea of where you're at. Let's watch this short video on paying yourself first.
Pay yourself first. Think you don't make enough money to save some of it? Think again. If you earn $25,000 a year for 40 years, you will have earned $1 million. Earn $35,000 for 40 years, and you've earned $1.4 million. And if you earn $45,000 for 40 years, you'd have made $1.8 million. Pay yourself first, and you can get ahead in the savings game. Here's what can happen when you save just $100 a month for 40 years. At 3% interest, you would have about $93,000. At 5% interest, you'd have about $153,240. And if you got 9% interest, you'd have about $472,000. That's the power of paying yourself first. After all, it's not what you earn, it's what you keep.
Awesome concept. Okay, it's an awesome concept of when you invest in yourself first. When you're creating a budget, you have to put yourself first. Don't worry about your car payment. Don't worry about a house payment. But get that money and put it away for yourself first, and then everything else will take care of itself. Okay, because you make enough money. That's the reality. And the reality is, how many families do you think waste $200 a month every month, right? Well, if you assign that money, say, nope, nope, that money's going to go for our future, that's when things explode. The next really important thing is called the time value of money. Okay. Time and consistency. There's a great question that says, when's the best time to plant a tree? 20 years ago. When's the next best time? Today. So your money will grow over time. That's just the fact of the matter. But if you wait, there's a high cost for waiting. So we're going to talk about the rule of 72, sometimes called the banker's rule. Now, if you do not understand this rule, this video is going to explain a little bit, but it's really something that you have to understand, because this rule is over everything. It's over your insurance, it's over your investments, it's over your 401k, it's over every single thing. This rule is what's prevalent, and this is what guides everything, all money concepts in this world.
Do you know the Rule of 72? It's an easy way to calculate just how long it's going to take your money to double. Just take the number 72 and divide it by the interest rate you hope to earn. That number gives you the approximate number of years it will take for your investment to double. As you can see, a one-time contribution of $10,000 doubles 6 more times at a 12% return than at 3%. How many doubling periods do you have in your life?
And that's the question that we have to answer, is how many doubling periods and how we're going to make our money work the best for us. Next thing is you have to pay off debt. Okay, this is just simple how money works. Debt is the biggest killer of future wealth. So revolving debt versus fixed debt. Okay, so revolving debt. Okay, that's credit cards. Okay, or furniture. If you go buy furniture on credit, this is what's going to happen. A revolving debt, $17,000 at 18%, paying $595 a month. You're going to pay that off in 17 years and taking 2 months to pay off. Fixed debt, $17,000 at 18%, $595 fixed month is only going to take 3 years and two months to pay off. So you have to understand how to attack debt the right way, and we show you how to do that in a really amazing concept called debt stacking. Let's take a look at this.
Debt stacking. By taking into account the interest rate and the amount of debt, debt stacking identifies an ideal order for you to pay off your debts. You begin on making consistent payments on all of your debts. The debt that debt stacking suggests that you pay off first is called your target account. When you pay off the target account, you roll that payment into the payment you are making on your next target account. As each debt is paid off, you apply the amount you are paying to that debt to the payment you are making on the next target account. Debt stacking allows you to make the same total monthly payment each month toward all of your debts, and works best when you do not accrue any new debts. You continue this process until you've paid off all your debts, and when you finish paying off your debts, you can apply that amount toward creating wealth and financial independence.
Buying the right kind of life insurance is another area that most people make a terrible mistake, because they don't know. And listen, when I first started in this business, I had no idea. When I actually started learning about other kind of life insurance, I was like, is that even legal? How is that legal that people can? And it's because the way people sell it. Most people don't buy life insurance, they're sold life insurance. Okay. And so one of the things that we try to do is we try to educate clients so they make sure they understand what they have, how it works, because if you don't understand it, you shouldn't really be paying for something you don't understand. So the right kind of life insurance. How much is your car worth, right? Do you insure it? Of course. How much is your house worth? Okay, you insure that for sure. How much is your life worth? Probably a lot more than your car or your house. See, it's not what you're trying to, you can't ever replace a life, but you have to replace the income. So here's a great illustration. You have a husband and wife, okay? They both make $2,500 a month, okay? That pays for their mortgage, their cars, their insurance, credit cards, utilities, groceries, childcare, entertainment, and the dreaded et cetera, right? That pays for everything every month. Their monthly bills, right, they're paying out $5,000 every month. Why? Because they're living like everybody else, paycheck to paycheck. Well, what happens if he dies? And I know, guys, I'm sorry, what if he dies? Okay. Well, how is that $2,500 ever going to pay for everything else? So you have to ask yourself this question: what are you going to lose? What is your wife going to lose? What is she going to have to give up? See, whenever I sit down across from a family, the thing that I'm working for, the person that I'm working for, is not the mom and the dad. My job is to make sure that the children are taken care of, to make sure that I work with a family so that they can provide in case, God forbid, something happens. That's what you have to look at. So if they have an insurance plan, a right kind of insurance, they're going to replace that income. And their family, unfortunately, lose the dad, but they won't change their quality of life. So here's a theory that our company put in place. It's called the theory of decreasing responsibility. Let's take a look.
Do you understand how your life insurance needs change over the years? It's called the theory of decreasing responsibility, and here's how it works. When your children are young, you probably have a lot of financial responsibilities, such as a house mortgage and other debts. During this time, the death of a breadwinner or caretaker would be financially devastating to your family. This is when you need coverage the most. In the later years, you have fewer financial obligations. The children are grown, the mortgage is paid or reduced, and you've had years to accumulate savings. Your need for insurance is reduced because you are now, in effect, self-insured. This is the theory of decreasing responsibility. It means having life insurance to protect your family during the most financially vulnerable years.
That's a strategy. That's a real strategy of protecting during a time and growing your wealth. So let me talk about licenses. I have a 214 life insurance and fixed annuities, not variable license. I have a Series 6, which means I can handle Roth IRA, traditional IRA, 401k, variable life, variable annuity, individual accounts, 529, 403, Coverdale, and I can roll your 401k into retirement accounts. Okay, so one of the things that's important that I want to cover with what kind of licenses the agent has that's going to be selling different products. Okay, I have a license that I have two licenses together that I can do anything, okay, for the client. But here's a great quote. It says, I suppose it's tempting if the only tool you have is a hammer to treat everything as if it were a nail. Meaning this, when you only have one license, you see everything through the eyes of that license. If someone has only an insurance license, will that person offer you something better when they can't get paid? Or giving them the benefit of the doubt, they do not even have that tool in their toolbox. So they cannot help you build your financial house the right way. So the problem with only having one license is you can only sell one product. You also have to understand that insurance is not an investment. We're going to cover that in a little bit later, but that's what I came across. I saw one client that works with this company that was sold a $93,000 policy as an investment. Okay. It was for 10 years. They were putting $65 a month into that policy. And I was like, how did you buy this? Because they put up a bunch of money up front into the account. Now, if they would have taken that same $65, they could have purchased $1 million policy for 10 years. So 10 years, $1 million policy versus 10 years, $93,000. Which one sounds better? So why are we here? We're here because a guy on YouTube, a group out there that are selling some questionable products to the Brazilian community. Now, are they legal products? Absolutely, they're legal. They're a way for the insurance company to grab a lot of money from clients. That's just what they are. There's no ifs, ands, or buts about it, and we're going to go over and we'll talk about it in a second. But I saw this video, and my wife, who is Brazilian, showed me, and both of us have a passion to educate Brazilians in the U.S. money and how money works here, how things work here. And so when I saw that video, and she's like, well, this client sent this to me and they asked me to explain it. And I got so infuriated because he was trying to tell people how to leverage their policy to get loans to invest in businesses. They were taking, and we're going to talk about this a little bit later, something that is to mitigate risk to create risk. Why would you create risk for your client? Our job is to protect our client and help them build their wealth for the future. So We're now going to talk about insurance, investment, and leverage. We're going to go over exactly what this guy did, and we're going to talk, but first I have to explain the products before I can even get into why it's such a bad idea. All right, so insurance companies, okay, they're for-profit business. My company is to make money, but you have to understand the way you make money is very important. To me, there's only one way to do it the right way. That's the way I've seen it. That's the way that works. That's the way that protects the client and give the client the best advantage, okay? I can show you by numbers, and we're gonna go over that in a second. But anyway, it's to make money. So you have to keep that in mind. Who's gonna make the most money? And what company is encouraging you to do things for your benefit or for their benefit? That's what you have to judge, okay? US insurance industry net premiums written total 1.3 trillion in 2019. You have to understand, are you an asset or are you a liability? Are you an asset or a liability to the insurance company? If you live, you are an asset. If you die, you're a liability. So how is an insurance company going to mitigate that liability? And that's what we're going to discuss, okay? So what is insurance? Insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against loss from an insurance company. The company pools clients' risks to make payments more affordable for the insured. Insurance policies are used to hedge against the risk of financial loss, both big and small. That may result from damage to the insured or her property or his property, from liability or for damage of injury caused to a third party. So insurance on a car, insurance on a house, insurance, medical insurance, everything is to mitigate your risk. You pay a little to have great protection. Does that make sense? Okay, that's the whole purpose of insurance, is to pay $100 a month to make sure that your car that's worth $30,000 can be replaced if there's a car accident. Simply put, that's what it is. It's to protect you and provide protection for you. What it isn't is an investment. Car insurance replaces or fixes the car. Now let me ask you this, is there any investment product added to that insurance? So when you pay your car payment, is it growing cash value or is it growing an investment? No, it's not. Home insurance replace home or injury to a visitor. Again, no investment product added. Medical insurance, I don't need to explain further. You understand, there's no other insurance on the planet that there's gaining investments than life insurance. That's the way life insurance was marketed since the beginning, was to create this sort of sense where you buy two products, but the unfortunate truth is, so you buy a death benefit and you buy cash value. The unfortunate truth is, most of the time you only get one. Life insurance is the only insurance that was marketed as an investment until the truth about those products were revealed, okay? So let's talk about life insurance basic, okay? So there's group insurance. You have to be employed to be covered. If you leave, you'll have to re-qualify to be covered with another company. When you leave, you'll only get permanent insurance. Now, let me give you an example. There was a guy that worked for the post office. He got injured in an accident on work, okay? After 6 months, he moved from an active employee to inactive employee. His benefits ended at that point, and then he died. And guess how much his family got when he died? $0, because he was on group insurance. You have to be actively employed if you die. Now, and the other thing about group insurance, if you have a bunch of smokers at work, it's going to jack up the prices even though you don't smoke. All right. Accidental death and dismemberment, ADD. I call it the life insurance that can't pay attention. All right. It pays only if an event of an accident, no matter when. This insurance only pays if you're in an accident. Extremely low premium, very high coverage. Okay. But here's the problem. If you have a heart attack, doesn't pay. If you're speeding and you get an accident, doesn't pay. If you have a low tire or a blinker out or something that's caused with your vehicle, you're in neglect, it doesn't pay. It is one of the worst, but that's why, you know, you pay a little bit at work, you think, oh, I have life insurance. You don't have life insurance, okay? It's only accidental death and dismemberment. Now, if you die of an accident, then yeah, congratulations, then your family will get paid something, okay? But the purpose of these are to mitigate responsibility. It gives you a benefit, but it's not really a benefit. The other thing about group insurance is, let me ask you this, is the benefits at your jobs going up or are they going down? Well, at any time, if you read inside of any group policy, they can cancel it at any time. Then what are you going to do? That's why we always recommend to have portable insurance that you take with you. It's yours. Nobody else owns that except you. Whole life. You pay for this insurance your whole life and has a cash value portion. But there's some problems with it, okay? Problem number one, for the first 3 years, there's no money. Now imagine if you're spending $200 a month on a whole life policy, and for the first 3 years, okay, you're looking at, that's over $6,000. There's no money in that account. Would you love a bank that you could put $200 a month in there and you go, hey, it's been 3 years. How much money is in my account? Oh, sorry, sir, there's nothing. If you don't believe me, let's take a look at your policy and I'll show you, okay? Next, if you want your money, you have to borrow it and pay back 6 to 8% interest. How's that feel, borrowing your own money, okay? And if you don't pay it back, they will take it out after the accumulation of the interest against your death benefits. So let's say you have 150,000, you took out, let's say you took out 10,000, but over the next 20 years, it grew and grew and grew, and they took that money away from your family. Next, when you die, and guess what, guys, we're all gonna die. You have to pick from the cash value or the death benefit. The company gets the cash if you pick the death benefit. So if this is the reality, again, it's in your policy. This is what I love when I sit down with a client that has this policy. I can explain it and show them how it works. And there's term life. Very simple. You pay, you die, company pays you. Low cost, high death benefit. Okay? So, and then whole life is mid coverage, 150 a month for 100,000 coverage or whatever, but it's you have to pay a lot of money for low coverage, whereas the term life you pay low amount for high coverage. And that's the whole idea is you, like we talked about the theory of decreasing responsibility. So let's say you pay 60 bucks a month for the next 35 years, right? So now you have only $60 for that coverage. If you die, your family's taken care of. But if you live, you invest the difference and that grows, that investment grows to where you become self-insured. If you have $1 million sitting in your investment account, do you need a $300,000 life insurance policy? No, but here's the cool part. What if you decide to keep that policy and pay off the taxes on the money that you, that's how powerful financial planning is. And that's what's very important. So here's what we're going to talk about today. It's called an IUL. And now this graphic is actually from a company that sells IUL, okay? How to choose the right type of life insurance for me. Male, age 45, good health, non-smoker. So here's their choices. Okay, this is what they created. Term policy, initial death benefit, $1 million. Now it shouldn't be initial, just it should be death benefit because term doesn't change. Premium, $186 a month for 30 years. Death benefit age 85 is 0. Cash value age 85 is 0. Okay, GUL, initial death benefit, $1 million, premium $749 a month. Death benefit age 85, $1 million, cash value age 85 is 0. Whole life, initial death benefit of $1 million, premium $14,000 a month. It's a little bit more than the 186. Death benefit age 85, 1.29 million, cash value is over $1 million. And IUL, oh, the angels rejoice. Initial death benefit is $1 million. Premium is only $3,952 a month. Death benefit at age 85 is 9.19 million. Cash value at age 85 is 8.75 million. Besides the $3,000 or almost $4,000 a month, why wouldn't you choose that? That seems like the no-brainer of all this, right? Wow, I have $1 million initial coverage, but then it's going to be $9 million if I die, and if I decide to take cash value, I have 8.7. Why wouldn't I buy that one? Now, do you notice something here? I want you to understand that the money, the $3,952 a month. The amount of money that agent's going to make on this is astronomical. They will buy a boat and put your name on the back of it. That's how much money they'll make on this one policy. That's why they're trying to sell it. So let's understand IUL a little bit, okay? Index Universal Life Insurance is an insurance product that seems to promise you can have your cake and eat it too. Unfortunately, as with most things in life, there are no free lunches. The devil's in the details. And when you really examine them, it becomes clear that these products are designed to be sold, not bought. You don't need permanent life insurance, okay? The vast majority of Americans, especially high-income Americans like physicians, will at some point no longer need to depend on their earnings from work in order to live. This is called financial independence. Once you reach that point, you generally no longer need for life insurance, okay? Number two, complexity does not favor the buyer. IULs have many moving parts. The more complex the policy, the less likely you are really going to understand how it works in the future. The less you understand, the more likely you're to be disappointed when they eventually compare the steak to the sizzle you were sold. Like any insurance investment hybrid product, you'll need to hold an IUL for the rest of your life to achieve even a low return. You are far likely to do less than when it turns out you bought something that isn't what you thought it was. Those who sell these commissioned products are highly trained, but not in finance. This is very important because they have an insurance license. They're highly trained in sales, but they know nothing about finance. They know nothing how to tear this down and create this. Why? Because they're not licensed to do so. Because they didn't go through the process of being licensed with the state of Florida, licensed with whatever state they're in, and also with the government, with the SEC, being a member of FINRA. They don't have to go through the stringent things that we all have to go through. Anyway, they're training in sales and what they're generally very good at what they do. They're great salesmen. You have to be to sell this product. Okay, don't look at this because they don't want you to see the truth. IULs don't count the dividends. You've probably heard that the stock market returns 10% in the long run. While this figure is approximately true, at least on the nominal, non-inflation adjusted basis. It includes the stock dividends, not just the change in the index value, the IULs. However, you only pay based on the change in the index. So what makes the money then? Who keeps the dividends? So the idea is that there's about 2% dividends paid on equity stock generally every year. But you don't get that. The company keeps that. The company's guaranteed 2% on your money. Not bad, okay? They keep the dividends, you get none of it. Number four, IULs have cap rates, okay? So if to make matters worse, IULs have a cap rate. That means that the stock market has a really great year, such as 30% index return in 2013, your return is capped at some lower figure, often the 10 to 15% range. How much does that matter? You go back 15 years to 1999 during the supposed terrible periods for equities, it has happened 7 times. If that cap wasn't in place, IUL purchaser in 1999 would have had 69% more value in their investment account. How do you feel about a company taking 69% of your money? Because they keep it, you don't get it. 5, IULs have a participation rate. I mean, that if that wasn't bad enough, there's also something called your participation rate. If your participation rate is 80%, that means that the stock market goes up 10%, not including dividends, you get 8% credit to your cash value account. After 30 years, nest egg growing at 8% instead of 10 ends up 42% smaller. Again, who gets that money? Because it's there. They do. Okay? We teach people how to buy term and invest the difference. So theoretically, this is how your money will grow at 9% over 40 years, a term policy for $1 million at age 45. So we're going to take a look now at what happens if you actually buy term. So you have $1 million policy. If you die, your family gets $1 million. Okay? And we're going to invest the difference. What's the difference? It's a lot. Okay, so let's look at the differences right now. 3952. Okay, so let's say they show the term policy is $185. So you're looking at the difference. Let's see, 3952 minus 180 is $3,700. Okay, we're going to invest $3,500 a month. So instead of, we're gonna keep the extra 200 bucks and have fun, okay? But let's say we're gonna take this policy, and we're gonna take that extra $3,700 a month, and we're gonna invest. Now let's take a look at this. We have their total amount of cash value is 8.75 million, okay? Now if they die, they only get 9, okay? They don't get the rest. They don't keep the cash doesn't stay with them, like that's done, okay? Now, this is a nominal, this is a very conservative fund, okay? And this gives you a 20-year period. Now listen, past performance doesn't predict future performance, okay? In their policy, also you have to understand that there's nothing, it's only on the index, the same S&P 500, okay? But watch this. This is only averaging 9%, but it grows to $12.9 million. Only 3 more million than the UL, the IUL. 3 million, okay? Now that's on a very nominal, very, very conservative portfolio. Now let's take a look at a more aggressive portfolio, okay? Especially one that's going back for 40, look at this. The final market value is $35 million. 35 million. A difference of 27 million more than the IUL. This is why we teach you to buy term and invest the difference, because it's going to grow much greater inside of the market that's being invested rather than having caps. See, you want to buy the market when it's down and when it's up. You have to understand that's how you make money, is when you buy low and then sell high. That's what happens. Also, you're going to have dividends inside of the funds that are going to pay you. That's going to give you more value to your portfolio. There, they keep the dividends. There, they keep the difference. So understand this, okay? They invest in the S&P 500. That's the index that they're using. They're going to make 27 million off of your money. They make the 27 million. You don't. Does that seem fair? Does that seem right? Now, insurance is this. It's all made with annual renewing term. Doesn't matter what insurance it is, it's purchased in annual renewing term. That means that your insurance is bought every year inside the product, okay? So if I'm a 45-year-old man, okay, and they're buying life insurance, do you think life insurance is going to be cheaper at 45 than 65? Yes, it's going to be cheaper at 45 than it is at 65. In a term policy, that's already worked in. So it's saying, okay, from 45 to 85, this is how much it's going to cost for that insurance, and they divide it out through that whole time, and that creates the cost. Whereas in an IUL, every year the cost of insurance is going up. So very simply, if they buy the insurance at 45, let's say it's $150 a month, and you're paying $3,900 a month. But as it goes up, at 65, that's going to be over $1,000 a month. Then at 80, that's going to be over $5,000 or $6,000. You understand that every year that it goes on, the cost goes up, and it goes up by multiples because the chance of you dying is going to be greater. So it's going to cost more money. Every year the cost of insurance goes up because you are older and your chances of dying goes up every year of your life. The problem is the longer that you have their policy, the chances the cost of the policy will outrace the investments. When that happens, here's the dirty secret built into every policy: your policy cash value goes to zero. After the cash value goes to zero, they will then call you and say this: hello, Mr. and Mrs. Client, your policy now is at a negative rate. That means that it costs more money than you're paying. So we're going to need you to add an additional $120 to $200 a month just to keep your policy in place. Wait a second. What about my investment? Well, this is what happened because of the market and because of X, Y, and Z, because of the cost of insurance. There's no longer any money in your cash value. You're going to be very upset, okay? But then if you cancel your policy, you're not going to have the death benefit. So then you're forced to pay the extra money. And that's when things get very sad. And I've seen many people have their their future shipwrecked because they just couldn't afford that policy anymore. As for the first years, there is no cash value in the policy, and after that, there's a huge punitive cost if you want to get your money out, called a surrender charge. So if you want to take your money out, they're going to charge you a surrender fee. Okay. So let's take a look at real life. Okay, this is Transamerica Financial Foundation. Okay, this is what this is not the the company or the people that I'm talking about. They use Transamerica. Okay, they can't sell their own insurance because their company can't underwrite their own insurance, but our company can. We do that all the time. Our company, that's how big our company is. Our company has have over 130,000 licensed agents. And so we underwrite our own insurance. You don't have to go to anybody else. But these guys have to go to somebody else. These guys have to go to Transamerica to sell the IUL. Our company only sells term policies because that's what's the best for the client. That's what we look at. Anyway, so let's continue. So the first 3 years of James' life, of his investment, his quote unquote investment, he has a death benefit of $6. How much is his cash value? Nothing. Second year, nothing. Third year, nothing. Fourth year, nothing. Zero. Okay. Now his cash surrender is $6,700. Okay. So after year 4, zero. After year 5, he's got a value of $1,533. Okay. But he's been paying $3,000 a year. $3,000 a year. So after 4 years, right, he's been putting $3,000, $3,000, $3,000, $3,000. So after 4 years, he's got $12,000 and he has no value. $12,000, no value. After the fifth year, he has $15,000, right? But he only has this value. Why? Because of the surrender charge. Is that not crazy? He keeps the surrender charge even up to here. See, it's 2637 and the cash value is 055. So it's so punitive. It hurts the client so much, but that's the goal. That's kind of the idea. Now, let's move forward. Okay, so this part I want to explain to you. You have age 36. Premium is $9,000 a year. Okay. Cost of insurance is $1,300 a year. Okay. Cash value. Look at this. 0000. Yep. Age 46. Right. Age 46. The cost of insurance or his premium is $9,000 a year. And how much is the cost of insurance? $5,594. So he's creating cash value. 56. Cost of insurance. Remember, ART. Premium is $9,000, but what's going on here? His cost of insurance is $13,000. That means he's $4,500 short. So you have to subtract that from the 69. That's going to be taken out of his investment. At 66, okay, 9,000 premium, 36,000 now in premium. Look at that jump. Why? Because the cost of insurance is going to go up the older you are. Now he's negative 27,000 in his account. And that's when they call him up and say, I'm sorry, we're going to have to increase your premiums just to cover this cost. Otherwise, your policy is dead. That's why that 85-year policy, that IUL with 9 million is crazy, because it doesn't exist. No matter what, that has to be, all the market's blowing it up, but they can't blow it up because the cap. It just doesn't equate. Let's continue. That's if every year it's at 15% hard line. I showed you what 12% was with $27,000 or $27 million. Now look at this. This is the penalty that starts to happen. Okay, still 3,000. Okay, they're paying this forward. Cumulative premium. So they've paid over 108,000. Look what happened. Cash value starts to go down. Why? Because they're paying the insurance. They're paying the difference until it goes to zero. This is the reality of an IUL. It's going to implode. And it only implodes when you really need it. That's what's so messed up. They put the surrender charge, so you can't get out of it at the beginning, and then it implodes at the end. The 3 Ds of investment. This is why you have to understand that insurance is not investment. You have to invest separately. 3 Ds of investment are discipline, diversification, dollar cost averaging. I'd love to explain that at a different time, but right now, those are kind of a great way of saying, I got to be disciplined every month. I've got to diversify my money, not put all my eggs in one basket. And dollar cost averaging is you invest on the downside and on the upside. It doesn't matter when, if you're investing, you will win. 3 things you have to beat when investing. You have to beat the market, you have to beat taxes, and you have to beat inflation. So in your investment strategy, your investment portfolio, if you're not beating those, you need to call us and so we can sit down and see if we can build something together. Here's another question, okay? This is called an investment questionnaire where you can sit there and you can go through and you can sit with a client and ask them their goals. What's your time horizon? What's your long-term goals? What's your short-term risk attitudes? Did your agent go over your investment profile? When they sold you this insurance product as an investment, did they understand your profile? One of the most important things when working with any client is understanding their goals and dreams. I know for a fact they didn't because they don't have responsibility to do so. They don't have a license to do so. They have a hammer and they're looking to nail someone. That's the problem with these people. That's the problem with these agents, is that they only see one thing. They're going to sell you something that they can only sell you. That's going to be their solution rather than having a real solution. And that's the problem. That is the deal breaker. Investing has to be unique to the person. When you take your state exam, suitability is one of the strongest topics that has to be covered. Suitability is the design of the program to the clients. Their risk tolerance, can you weather some losses and gains? Time frame, how long do you want to invest? And liquidity, meaning the access to the money. If you look at the IUL, it locks your money up, and then later on you're smoked. What else does it do? It may say, okay, it doesn't give you a lot of risk. There's not, I put my money in yeah, but it's still a risk because the policy is going to eat it. In time frame, how long do you want to invest? Well, they're telling you got to invest for 40 years, lock up your money. You got to keep paying. If you don't pay, policy's dead. So it all comes down to this. This is what got me so frustrated. The agent who was making this YouTube video was teaching people to leverage their cash value to get a loan. The very purpose of any insurance is to mitigate risk, not put you into more risk. So understand this. He was telling the clients, his clients, the cash value that you've grown in your account, rather than borrowing against it at 8%, go get a loan against your cash value from a bank because it's an asset, they say, for only 4%. Now, who does that help? It helps the insurance company because you're not taking the money out. They're not having to come up with $10,000. That's your money. They're not having to come up with that and give it to you. He's putting you at risk. He said, yeah, you can go invest that money in a business or in gold or in whatever. Now, why would he do that? Because he's protecting the insurance company. What if gold falls out? What if 7 out of 10 businesses, right, fail? If you take $10,000 loan from a bank at 4% and then you invest in a business, 7 to 10 new businesses fail unless you buy a franchise. And 10,000 won't buy you one of those. So if you lose the 10,000 and the collateral is your cash value, what happens then? You still owe 10,000. You have to pay on that 10,000 and your IUL policy. Who took the risk? Who didn't take any risk but profits off of this decision? That's what you have to ask that question. Listen, when you buy a policy from me, do I make money? Absolutely, because I provided a service. I've taken the test. I know how to do that, but I'm also going to give you a strategy so that you win on both sides, an offensive and a defensive strategy. They make the money because they didn't have to give you any of the money back. Because if you want to take a loan from your own money, your policy, that'll sink in. Let that sink in. You're gonna get a loan of your own money. They'll charge you 68% interest on the money. By the way, but this way, you get a loan and they keep your money growing for them. Your money continues to make money for them. Do you see how brilliant and wicked this is? By encouraging people to do this, who makes all the money? Who saves all the money? The insurance company does. So who wins? If you want to understand this, you have to understand the heart of the person who's selling this to you. Now, this is just reality of the company. The term policy versus the IUL. 395, 3,900. Now remember, guys, these are their illustrations, not mine. This is what they did. $395, I'm sorry, 3,000, I just can't get over $3,952 premium per month. Cash value at 85 is $8 million. 27 million lie in their pockets. And the policy eats itself over time. If you miss one payment, your policy is gone. And it's a really confusing policy. Term, 186 a month, investment at 85. You have 15 million by investing in the difference. The policy ends when you don't need it, or you can renew it with our company, guaranteed no matter your health. If you miss a payment, we have grace and the policy is still in force. It's an easy strategy for building generational wealth. So who wins on the IUL? Easily, it's the company that wins. Who wins on term, buying term and investing the difference? You and your family. This is not trying to, it's just, let's put apples to apples against each other. That's what they did in their presentation. So I want to tear apart so you know the numbers behind it, because numbers don't lie. Well, their numbers do, but numbers don't generally lie. So bottom line, if you work for a company that sells this garbage, you need to examine your heart. Find a different company, okay? Don't sell this product. Now, I know the temptation to sell this product is huge because you make so much money on it. You make so much money on IULs. You make so much money on whole life. You hardly make any money on term. Why? Because it's great for the client, not for the company. It's the best interest of the client. If you have purchased this product, you need to speak with me as soon as possible, and we'll get you out of that product and get you into one that will build a solid retirement plan. I sat down with a client. He had this exact kind of policy, paying $400 a month. He had $14,000 in the value of it, but the cash surrender was over $12,000. No matter what, he was not getting his money out of this account. No matter what. We replaced that with a policy that was more coverage for him and his wife for less cost. We were able to take the difference and invest that systematically. He now has more money in his account than he had ever before with them. But it's his money. He can get it at any time. Use wisdom. If something seems too good to be true, run from it and make sure you understand every financial product on your own. Thank you for your time. You can contact me at 407-738-8200. At my Gmail, give me a ring there. But we'd love to serve you. We'd love to help you. This is our passion. There's my beautiful wife, Kelly. Anyway, God bless you guys. You have a great day, and hopefully this has helped in some fashion.